Hit it.
It's Friday, January 26, 2024, episode 231. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show Bond Portfolio Manager, Efficient Market Hype. We have a fascinating discussion about interest rates, the difference between hard and soft data, and why he sees a violently range-bound market ahead for 2024. Then it's time for Talking Charts, where Patrick has hopefully not bitten off more of the crayon than he can chew when he tries to make sense of this topsy-turvy equity market.
We end with crayons with Kev and no stupid questions. And folks, we might even drink some beers along the way. Now, normally, I tell Lena to hop on, but today we have our audio wizard, Daniel, jumping on in her place. Now, Danny, come on for your debut.
Bonjour.
Bonjour.
Don't make us pretend like you're French.
Oh, yeah. I'm not going to embarrass myself there.
So, Danny, what beer am I drinking today?
This week, the lads are drinking Theatre of Madness Pumpkin Lager. The spectre of pumpkin beers lured us to stage this bizarre incarnation of the unexpected, but this time in a lager. Brewed featuring pureed pumpkin, co-starring the trio of cinnamon, allspice, and nutmeg, and orchestrated with a creamy dollop of lactose.
Makes that sound really good. Actually, it does taste pretty good. It's like a pumpkin and barley stalk had a baby. Voila. It's like, it was the last of the stock of the Thanksgiving inventory at the liquor store, Kevin. I had to get it on the show before seasonally it's gone. So
it sounds terrible.
It actually is really good.
Okay.
All right. Anyway, give us our side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the Powell pause paranoia. This is the irrational fear that any pause in Powell's speech hints at a major unspoken economic catastrophe. Ooh. Or the economic jargon jumble, a temporary linguistic phenomenon where one starts speaking exclusively in economic jargon after watching too many FinTwit Doom podcasts, leaving friends and family utterly confused. And finally, watch out for inflation illusion illness, a humorous malady where everyday objects seem to inflate or deflate in size, mirroring one's anxiety about interest rate or inflation rates.
All right, let's get the guest on the show.
It's our great pleasure to welcome to the show EMH. And for those who don't know EMH, he is Efficient Market Hype on Twitter. He's probably one of the absolute must follows on Twitter. It's EFFMKTHYPE. EMH, thanks for joining us.
Well, thank you for inviting me. I feel very honored.
Yeah, so this is going to be a lot of fun. I've had the pleasure of meeting you just once, but we've chatted numerous times. Rumor has it that when the Bloomberg help desk gets stuck, they actually phone EMH. That's how good he is on the Bloomberg. Before we talk about that, why don't we get to know you a little bit?
Sure.
You're born in Singapore. Can you tell us a little bit about your background and how you got to the finance industry?
I mean, it's a long story of struggle, but a short story of a career success. I was born in Singapore. Terrible student. Was sent overseas to Australia when I was around, I'd say 9. That was the only hope.
Your parents just picked you up and they said, you got to go? 9 years old.
Yeah, basically. The question really was, do you want to go to Australia? My response was, do I have to do Chinese? Because I was terrible at Chinese and that was really dragging me down in school, which was really important. And they said no. And I said, pack our bags, let's go.
Sold to you. Yeah. I mean, I'm bought from you.
Pretty much mine.
So you pick up at 9 years old, go to Australia. That must have been quite a switch. Like, did you adapt well? And did you live, was it boarding school?
It was boarding school. It was fun. I mean, when you're little, kids are resilient because you're unaware, right, of the world. So, you're full of hope and optimism. You haven't really been jaded by trying to trade the S&P just yet. So, it was a fun time.
Now, EMH, you keep being very self-deprecating, and we all enjoy that, especially we as Canadians. We can appreciate that. But yet you sit here and you say, oh, I wasn't a good student. I didn't do this well. I didn't do that well. And I am not kidding when I say you are the absolute best Bloomberg whiz that I've ever seen. I am pretty sure that Bloomberg people go and look at your Twitter feed and say, I didn't know about that function. I didn't realize that existed. There were so many things like backtest and study and things that you've opened my mind, and kind of my Bloomberg world has expanded tremendously because of you. So I'm only going to buy your kind of humbleness so far.
Okay.
Because you have to be one of the absolute best, Bloomberg wizards there is.
I'll try to temper it a bit, but I mean, it brings it back to, the point about the training that Bloomberg does too, right? It is pretty robust. You do get a good kind of foundation as to how to use the terminal.
Right.
They factor in a lot of, academic theory, right? So you will cover things like bond math or whatever, right? You can choose, do you want to be an equity guy, a fixed income guy, an FX guy, commodity, currencies, that kind of stuff,
Oh, okay.
Right?
So you choose a general kind of path.
Yeah.
And they teach, and then you learn it all. So you obviously, did you choose fixed income?
I did choose fixed income. I mean,
Okay.
when I was in university, right? It's always very equity heavy. There was one module for fixed income, which was known as the hardest module to go through.
And you're just like, screw it, I'm going to choose the hardest one.
Well, I enjoyed that, right?
Okay.
I enjoyed that module. When it came time to work and I was like finding myself at Bloomberg, I mean, just look down at your keyboard, right? That rainbow keyboard, the yellow keys, count how many of them are fixed income keys, right?
Oh, yeah. Well, Bloomberg started as a fixed income product.
Exactly. So why would I go
like
there?
It's Salman Brothers. Or wait, no. Is it Salman? Yeah, it's Salman, isn't it? Yeah. Yeah.
Well, he got fired from Solomon, right? And he took the money and then he created this with the backing of Merrill.
Oh, that's it. Okay.
Yeah.
I think that Solomon probably thought that ended up being a bad trade for them. Okay, here's a question. I'm going to put you on the spot. What do you think is the most underused or underappreciated Bloomberg function?
Oh, you got to do this to me.
Yeah, come on. You're just so good at it. Tell me one that you're like always like, oh, I can't believe more people don't use this.
I mean, for me, the STDY function study,
right?
I like that a lot because it does allow you to not just edit the defaults of your technical indicators, but it does allow you to build your own. Once you get the hang of it, I think that tool is an aspect that allows you to really extend the use of the terminal, right? And manipulate data, especially if you're like me, if you're a very visual person, right?
Yeah.
Being able to kind of, take your own data sets, manipulate them into, a certain way you want to see things. I think that's pretty important, right? I mean, the easiest example is, let's say you wanted to look at break evens, right?
Right.
But you were trying to look at how they react to the momentum of crude oil, right? But rather than just using moving averages and crude oil, you want to look at the MACD, right?
Right. Okay.
So, you can use technical studies through that STD function to, just create all these type of technical indicators just specifically for, say, like crude oil, right? And then you can, throw that into a chart or even the backtest function for, say inflation break-evens, right? And then you can look at it there.
You can mix asset classes a lot easier and then also look at the results in the past. I know, like, as I mentioned, you opened my eyes to what Bloomberg can do. And I feel like that most Bloomberg people don't realize. And actually, I almost worry about this STD and the STDY. I mean, it sounds like a sexually transmitted disease.
Yeah.
I'm worried about
Kevin,
STDs.
You're worrying about STDs. Okay, buddy. It's not that type of podcast, but okay.
I worry about it because it feels like nobody uses it. And yet it's so powerful. Like, it's just unbelievable. And I'm just constantly amazed in terms of your ability to understand these things. So you were at Bloomberg. Eventually you go and you get a job on the buy side. And
Mhm.
is that as a portfolio manager for fixed income? And is that just the direct result of learning so much at Bloomberg? Like, was that one of your clients that you ended up working for?
Well, yeah. So from Bloomberg, I went into the asset management side. It wasn't it wasn't like a client. I mean, they were a client, but
Yeah,
I
but
didn't know them
you didn't
directly.
know them. No, you
No.
just went and got the job.
Yeah,
Okay.
it was like a long slog, right? So,
Right.
that was part of the problem and part of the reason why I also decided to leave Bloomberg, because I learned very well, like, what things are, like how they work, right?
Right.
But I didn't get to see, the after. So if I help someone, price out a swap, right? And,
Yeah.
like, very often for them, it would be like trying to compare and make sure that, the pricing they're getting on their swap is the same as their brokers, right?
Okay.
So they would get a quote, they would see it, it would be like different, and they'll, maybe just ask, all right, why, right? So, the process is to get them to, like, go through settings and stuff like that. But you need to understand how a swap works, how to price it, and all of that. And then he'd be like, okay, great, and then he's like, thank you, bye. Or right, and that's it, right? Or like sometimes the guy would be like, can you I'm trying to look at a floater, right? And I want to price it, but I want to do it in Excel. I want to pull out all the cash flows, but I also want to, be able to model them by the forward curve rather than just assume static coupons. But I want to do it in Excel.
Okay.
So it's like, okay, sure, this is how you do it, right?
Okay.
But then, okay, thanks, bye. And then if you are naturally hungry, right? Intellectually hungry, you always want to know, like, the after, the what then, right? And I also want to know the why. Why were you looking at this? So that starts to kind of eat away at you. And then, you kind of, admit to yourself that, like, for me in particular, I want to go out and I want to go out and I want to do this, I want
Okay.
to do what these guys are doing. So that's why you kind of step out. And, I went out to look for a job. But, part of I guess, the struggle that you would inevitably find is, you might have knowledge, but you don't have experience, right? So,
Yeah.
it's important for, like, people to, give you a shot. So I definitely didn't step in, to my first role in fixed income as like a PM. It was like an analyst role. So it's just an
Right.
investment analyst. It was just to, like, figure out, what are they looking at? Why are they looking at it a certain way? I think the first thing I got asked when I sat on the desk was, here are all these perpetuals, right? Like, perpetual non-call fives.
Yeah.
Tell me which ones are going to get called in the next year or not,
Oh, okay.
And it was
That's like
and I was like, okay,
That's actually sounds like a pretty fun little project.
It was, but even if you ask me till today to do that, I probably don't have a good answer for you. I don't think anyone does, right?
No, listen, we're all just making up crap as we go, as it is. Okay,
That's right.
So let's get to the markets a little bit and chat about you. You're a big bond PM now, and we want to know what you're thinking about the markets. And one of the first things I've seen you talking about recently is hard and soft data. Okay, and I remember hearing Mike Wilson, the Morgan Stanley strategist, talk about this. I think it was 6 months ago, might have been 9 months ago. And he said something to the effect of, there's never been this much of a difference between the soft and the hard data. At the time, the soft data was going straight down and the hard data kept going up.
Yep.
And he says, although it's tempting to say this time is different, he says, the soft always leads the hard, and this is not going to be different. And yet here we are. And it actually seems to maybe it is different. Okay. So could you first explain to what people mean by soft and hard data? And then could you try to talk about why this time it's been such a poor predictor of the hard data?
Okay. So first of all, soft and hard data, right? Soft data is data that isn't well, I wouldn't say isn't real, but it's a lot of it is like sentiment type of data,
Right.
right? It's about
Forecasts or opinions by people, surveys.
forecasts and feelings, right?
Right. Okay.
And when it comes to feelings, people aren't entirely rational sometimes, but feelings can also be volatile, right? Hard data is actual data. So when you're looking at things like retail spending, right? That's
Right.
hard data. That's stuff that actually has happened. When you look at industrial production, right? That's stuff that was actually produced. So that data is tangible, right? You can count it. You can audit it.
Measure it.
Yeah,
it's
you
a,
can
it's a
measure
real
it.
thing. I got it.
Exactly.
Okay.
Right. So when it comes to hard versus soft data, I mean, one of the classical kind of charts you might see out there is things like PMIs, right?
Okay.
Which are manufacturing surveys. Those are like a diffusion index. So they'll ask you, do you think things are improving or they are deteriorating and getting worse, right? Do you think they're
Right.
expanding or do you think they're contracting? So because they ask the questions like that, you'll get responses of maybe 40% say are expanding, 20% say it's contracting, right? So
Okay. I'm with you.
so from that you can get a reading, right, of a net amount, say net 40 positive, right? So that's 40% in general, right? It's expanding, right? But those are feelings, so they're looking 6 months ahead, right?
Okay.
What do you think is
And
going to happen?
generally, the soft data is a good leading indicator of the hard data. Yet
Generally,
this time it hasn't been.
no.
First of all, do you have a theory why this time it hasn't worked? Are we just later? Like, is it gonna work and we're just later, or is soft data in itself become way less predictive than it has been in the past?
I think it's always been about having enough time in order for things to normalize again, right? The reason why, in my view, it went out of sync, right? In the stuff like those Twitter threads I talk about, I call it economic syncopation, right?
Okay.
And that's just, there was a natural rhythm to how these things were. Things like PMIs typically were like 6 months ahead of hard data like industrial production or capacity utilization, and that kind of stopped being the case, right? And it was disrupted
Okay.
because of the pandemic, the shutdowns,
All right.
basically, right? So
Okay.
when you are slowing down, like you got to remember 2019, going into the end of 2019, the world had already thought that we were like heading towards a recession, right? PMIs
Okay.
would head it down, right?
So the soft data going into like at the end of 2019 was already indicating that we were headed into a slowdown / recession.
Yeah, it was, right?
Okay.
And when you look at the yield curve was also
It inverted, right?
Yeah, it had briefly inverted just before, right?
Yeah.
So there were a lot of these signs, and a lot of the discussion in the market was, are we going to have a recession in 2020, right? But these cycles are slowdowns, right? It's called a slowdown for a reason, right? And they're not called crashes for every time, right? It's only
Yeah.
it's only certain events you get a crash, right?
Right.
So
Okay.
that's where that phrase, right? It's like when you're driving the car, it's not speeding that kills you, it's stopping very suddenly.
Okay. Yeah. Okay. I like that.
So
Okay.
it's the same thing, right? So when we got to the slowdown that everyone thought was going to happen, it wasn't a slowdown. We had a pandemic and the world shut down. It literally shut down, right? So when
Okay.
that happens, right, of course your PMIs are just going to hit the floor, right? But
Okay.
at the same time, industrial production, all your hard activity is also hitting the floor, right?
All
So
right.
everything
Okay.
grinds to zero. So now what was a 6-month lead has now just compressed into a 0-second lead, right? Everything
Okay.
is on the same point of time, right?
Okay. I'm with you.
All right.
Okay.
So
There's no more of this lead lag. It's just we're both at the
Correct.
same spot.
No more
Okay.
lead lag,
I'm with you.
right?
Yeah.
And then now we get into this whole aspect of feelings, right? So it's the same as like bulls and bears, right? When the Fed came in and said, look, we're going to start all these facilities, including buying high yield debt, everyone, you either said, this is so bad that they have to do this, the world is over, right? Or you
Yeah.
said, this is fantastic. I am going, balls deep on everything that I can. I'm margining all the money I have, right?
Okay.
And through that whole rally, you still had bears who were like, any day now, this is gonna, get worse. When the Delta variant swept through, right? You had some jitters in the market. People also kind of thought like, all right, we're gonna go down another 1,000 points on SPOOs, right? So
Yep.
those sentiment feelings are very, very strong, and they can drive a lot of your behavior, right? And it's the same when it comes to these surveys and these PMIs, right? So if you're a producer, you went through a shutdown where everything stopped, right? You're trying to open up, but now you've got supply chain snarls, right? Everything is gummed up. You can't get the materials you need, and even if you can get them, now those costs are going through the roof, right?
Right.
And
then not only that, then once the economy did fully open, we had the Fed going and doing this massive, aggressive tightening, the likes we haven't seen in 40 years.
correct, right? So
Right.
when it comes to the soft data, you can kind of like frame it as people thinking it's too good to be true, right? Like
Okay.
2023, when we went into 2023, everyone thought we're going to have a recession, right?
Oh yeah,
And
it was the most anticipated recession we've ever had, right? Like the market was completely sure that it was going to happen, and yet it didn't happen. We actually had one of the strongest economies.
Yeah. And
well, listen, sorry, I didn't mean to interrupt, but my buddy Dario Perkins from TS Lombard, he loves to say that we're sitting around applying, and I'm paraphrasing from him. So Dario, I hope I get this right, but I think his argument is that we're sitting around trying to put this regular business cycle on this point in time that is anything but a regular business cycle, meaning that we went, as you said, we shut down the whole economy. We started it up, but then we only started up half of it because we didn't allow services. So we just allowed them to build stuff. And so everyone, and not only that, we mailed everyone checks. So they all had money. So they all tried to buy stuff at once. And then, we have inflation and his argument is that we're all sitting using this old playbook and expecting the economy to behave in this regular fashion when we've applied things that are completely and utterly different than all the other times that we've had an economy. Do you buy that argument, and do you have anything to add?
No, I mean, I buy into that.
Yeah.
But the counter, the general counter I have to that is the fact that this whole time, and the human condition as well, right, is a drive to get back to normal, right? That's been like a phrase that everyone's been always throwing around as well, right? Like back to normal or normalization, right? I have supply chains normalized, which they have if you look at the supply chain index, right? But it's always been about trying to get back to normal, and that's also this whole thing that when I write about them and these views about hard and soft data, to me it initially was trying to explain why they didn't work, right? And like I explained, it's this sentiment that things are not going to get better, right?
Okay.
But for some reason, the consumer's strong, everything holds up. So you get this divergence, right? But the other aspect as you progress is, are we getting back to normal, right? So is that lead lag kind of, coming back in, right? So
I see. So are we naturally getting back into the regular rhythm of an economy?
yes, right? So you need enough time for you to do that, right? So the way I think about it in a very simple type of framework is just, sure, like let's say ISM manufacturing is like minus 40 is 45, right? So it's under 50, right? Anything under 50 is contractionary, right?
Okay.
Now at 45, right, it's short, maybe that number is low, right? But the question is, does it stay at 45, or does it keep going down to 44, 43, 40, 35, right? Or does it actually kind of recover?
Right. Okay. I'm with you.
All right. So if it can even stay at 45, right, it means that sentiment isn't getting worse, right? And you can go up to 47, let's say, right? And you're still under 50. So, empirically and the way people read it, they'll say it's contracting. But from 45 to, 47, you've improved, right? You've gone up. So,
Okay. I'm with you.
so it was a question to me of, if hard activity is not actually slowing down, right? Can the economy actually sustain itself long enough for people's, sentiment to actually normalize back, right?
And
So
if that was the case and we did normalize back, would you then argue we're closer to a more normal economy where the next time the soft data dips, that it actually might have the hard data follow in the 6 months later or whatever it typically is?
yeah, I think
Okay.
we're pretty much, at that stage, right?
All right. So you're saying that this could almost be the last divergence between the hard and the soft data. If I got that right?
Yeah. I think we've pretty much kind of washed out a lot of this, lack of synchronicity between the two.
All right.
And you're kind of at a stage now where you do want to look at soft data and you do want to see, where they are going. All right.
Oh, I see. So even the change from here is going to matter.
Yeah, the change from here is definitely going to matter, right?
I see what you're saying. So it's not the fact that it's at 45 from here. It's more of a question is like that yes, it's lower than it should be. It's showing that we're slowing, but it's whether we get even worse will be the sign that 6 months from now or 3 months, whatever it is,
yeah,
we should expect to slow down. So one of the things you said is,
right?
Sorry, go ahead.
Or the flip side, right? If this stuff keeps going up, right? And you see soft data going up, right? It might be a sign that, activity is also going to pick up, right? I mean, look at retail sales, look at the consumer over the last quarter. This, not even the last quarter, the last year, it's been incredibly strong, right? So,
right. So you wrote here, you said either we have a recession really soon or I think the Fed needs to hike. I know that's kind of tongue in cheek, but the reality is the Fed is like, we're talking about the Fed not hiking. We're talking about the Fed lowering rates. Is your argument that if we don't actually get the hard data rolling over and the soft data might even improve as the hard data doesn't roll over, the Fed will not be doing the amount of cuts that are priced into the market?
Yeah, I mean, look, what are we priced for in 2024 right now? It was like 5+.
I think 5.5 or something. Yeah, like
5+,
something like
right?
that. Yeah.
And as far as the Fed is looking at things, they're looking at 3, right?
Okay, in terms of the SEP or whatever, what they said. Okay, I'm with you.
Those dreaded dots. Yeah.
Oh yeah,
right?
the dreaded dots.
The dreaded dots, right? So I mean, the question is, I mean, yeah, they might cut, right? If they cut in March, I don't really think that's much of an issue, right? I think a few people have also, mentioned that and come around to that idea. For me, the main issue is the amount of cuts priced into the year, right? So for you to, to see them, be cutting, 125, 150 basis points in the year, what does activity look like, right? What does the hard data look like? And, can the soft data give us some clue as to that as well, right? And I mean, we just had the GDP data for Q4, which was
strong, right?
It was strong, right? And you saw at the same time, personal spending came out. Personal spending blew the doors off, right? They were much stronger than people expected. And we kind of had a hint of that with retail sales in December, right? So, how much is the economy actually slowing, right? And if we keep continuing with this amount of activity, how much do you expect the Fed to actually lower rates? How much can they, right?
Why do you think the market is so quick these days to run ahead and price in so many cuts? Is it because they're uncomfortable and they ultimately don't believe the economy can be strong at this level?
I mean, that's
And
that's a
and by the
tough
way,
question.
doesn't this make your job very difficult as a bond manager when the curve keeps inverting like this? Because
It
like when the
does.
because like let's face it, when the curve's nice and steep, it's easy. You just go and buy bonds and ride the curve. And this is just making it so like you have to play this game, and the moment that that gets too inverted, your carry's negative, and like it's just a pain.
Well, yeah. I mean, curve trades for, well, let's call it the last 12 months. All right. Curve trades,
Yeah.
especially steepness, have been very painful for a lot of people to try and hold. Right. If you can manage it appropriately, you won't have died. Right. But you're certainly not getting the joy you wanted. Right. So we can talk about the yield curve and forwards and all that in a second. But your original question about like why doesn't the market um kind of agree? It's a question I think a lot of people in the macro or bond space is trying to get a firm answer to, right? I think in general
Yeah.
though, people can't. The market is not very effective at pricing in nuance, right? So
Okay.
like I said, right, you can march to cut and march. To me is sensible. I wouldn't deny that, right? The
Right.
question is, if you're using, say, a soft landing playbook, right? I actually wouldn't expect the Fed to cut and keep cutting every meeting, right? 25 basis points, right?
Right. And isn't that'll be the challenge if they cut in March, is that the market will run ahead and
Correct,
actually
right?
price in 25 beeps a meeting.
Yeah. So, that's why, like, I've told, some people when I talk to them, my expectation for 2024 is kind of range bound, like violently range bound, right? So,
Violently range bound. I like
yeah.
that.
So, if I told you the year's going to be range bound, you might say, all right, then sell vol, right? Because you're going to be stuck in that. But I'm telling you, it's probably going to be a year where if you try to sell vol, at the edges of those ranges, right?
You're gonna
Just
be covering. You're
wear
gonna be crying in pain.
wear brown pants that day, right? Because you don't know how it's going to turn out, right? Because I think you'll move to those edges in a very violent fashion, right?
Okay.
And then you'll come back. So it's that thing about not being able to price nuance. March to cut in March seems reasonable. If they do cut in March, though, right? The market isn't really, I think, like kind of capable to say, sure, then they'll pause, they will watch and see, right? And then they might actually hike back up if things don't slow down, right? But they might cut as well, right? If things do actually slow down. So, you know, the expected kind of value that you should get to at the end of the year, maybe it's 75 basis points lower, right? But that's because the odds of them cutting 5 times is not 100%, right? It's predicated
Right.
on us seeing data slow down, right? If you had GDP, not print like a 3.3%, you had them print like a 1, you would probably see that come in. So that's why
Right.
when we had that GDP data and personal spending, you saw some of these odds get pulled back a little bit, right? Because if you were the Fed, you might not actually think you need to cut that much, right?
Right. So one of the things that always frustrates me, and I must admit, I am an equity guy that pretends to be a bond guy.
Oh, great!
But
I'm the opposite. So
but I'm always shocked at people, like they often will just say, oh, the Fed's cutting, so I'm going to own the long bond. I'm going to go buy TLT. And I'm like, no, it doesn't work that way. That, and you touched upon it with yield curves.
Yep.
And well, let's just first of all talk about this October, because I think it was a very interesting time. I had been a bond bear for a long, long time. And at the end of the day, I believe we can create as much inflation as we want. And ultimately, we would probably create too much inflation. So therefore, on the whole, I'm kind of an inflation bull over the long, long time. I'm an inflation bull and a bond bear. Having said that, in October, things got so bad and they were so, hyperbolically bearish. I was like, I feel dirty for doing this, but I'm actually going to buy bonds here. And this was very unusual for me because like I used to joke and I said that I used the Dennis Garman line. There's 3 positions you should have for bonds. It's like flat, short, or really short. But I was like, even like October was so bearish. I was like, I'm going to buy bonds. And it was like, I was listening to these folks come and lecture me about term premium and these claims that the Fed or the US wasn't going to be able to fund itself. And I was just like, listen, the fact that you're telling me about term premium and you really don't know what it even is, and is the fact that you're worried about it is a sign that you should be buying bonds. And it was correct. That was the right play. But I'm just thinking, me as kind of a true bond tourist, you must just be like pulling your hair out when you start to see like FinTwits start talking about term premiums and stuff in October.
Well, I mean, that's not too bad. No one knows what term premium is. So
I know it's true. The more you know about bonds, the more you realize that nobody really knows what it is.
yeah, it's the life of trading bonds is just a sequence of realizing less and less.
That's right. Term premium is just like the part when you can't explain why bonds are moving. It's it's the fudge factor.
Yeah, it's the fudge factor. It's the plug.
Yeah, that's right.
It's the appendix of the financial anatomy.
But did it drive you nuts? Did it drive you nuts? Useless, but it bursts. Did it drive you nuts in October with like the bearishness out there and the reasons and the thoughts that the U.S. wouldn't be able to be able to fund itself?
I mean, the bearishness, not so much. I think these arguments of the U.S. not being able to fund itself, that stuff to me, I'm like, let's be real. Okay.
Yeah. So you just miss it. Like you just don't even think about it. Okay. Here's a question for you then. How much do you think the QRA moved moved the long end? Because I push back on the QRA completely. I say, you know what, like the reality is that it wasn't as big a deal as everyone makes it out to be. And it was more just the narratives going around than it was the actual announcement of the QRA. Would you agree or disagree with that statement?
I would tend to agree with that statement, right? It's about when you're trading, you got to respect flows. You have to respect narratives, right?
Yeah.
And your ideas of fair value and what actually matters, it doesn't matter, right?
Okay.
At the end of the day, price is all that matters, right? And the flow will determine where that's gonna go, right? So QRA, did it actually matter?
For those, I don't mean to interrupt. For those who don't know, QRA is a quarterly refunding announcement, and it was basically the amount of bonds that Yellen chooses to issue as a treasury.
Yeah.
Sorry, you were saying, did the QRA matter?
Yeah. So, I mean, the QRA mattered insofar as it kind of was like the beacon of bond bearishness, right?
Okay. Yep.
People were just bearish bonds, right? They didn't like them at those levels, and you could see 5% in sight, right? Are we getting towards that? Are we going to break through that? Are there a bunch of stops sitting just above 5%? Are we just going to run them over? All that kind of stuff, right? And to top it all off, it's, hey, you've got this QRA coming up. The last one that we had at the end of July, start of August, was way bigger than everyone thought, right? And the composition, was had a lot more longer end, so that's a lot of supply for the market to take down. So that was kind of feeding into it, right? It was just this collective pessimism of everything is against bonds right now.
Okay.
Right? So it's important to just understand at the time the sentiment, right? And that narrative.
But it was more the sentiment than it was the actual announcement of the supply. Like, here's a question for you. Do you worry about a gilt style crash in long end U.S. treasuries?
I haven't really looked into that all that much, but I mean, I would say that the UK market, is probably going to have things a little bit more difficult than the U.S. For a couple of factors, in terms of just how the central bank is managing things, but also their inflation battles, right? I think that I don't think it'll be something like the U.S.
So you don't. So although you won't discount and say never, like a great trader never says never, but you don't think that is a likely scenario in the U.S.
No.
Okay, fair enough.
You mean the you're
like a
referring
gilt style, like a crash at the long end where the Fed actually has to go from doing QT to QE very quickly because the long end goes no bid.
Oh, okay. No, I heard that the other way around.
I'm sorry. Yeah.
You're
No,
talking
I'm
about
saying
when that LDI debacle happened, right?
yeah, or just in general. Do you worry about the LDI in the UK? That's correct. Like that sort of event occurring in the US. Do you think that's a realistic worry?
I mean, yeah, like you said, a trader will never say never, right?
Yeah.
I think it's less likely to be the case. But I mean, it's certainly possible, but I don't really think so, right? Given where we are in the cycle, right, and given where rate volatility has stayed, over the last 24 months, right? You might think rate volatility is low, but the move is still 100.
It's still right. It's still up there.
Yeah.
And to your point, actually, I was going to ask you about volatility. And since you brought up because you said this violently range bound and you said, be careful selling fixed income vol, although we might not go anywhere. The path upon which we go nowhere could be violent. And I completely agree with that. And you said recently, I saw you say something on Twitter. Is like you said, there's been a material bid in equity implied vol of late, especially in relative terms against rate vol. What's important from my view is that positive skew on bonds is deteriorating. Why don't you kind of explain to us how you see the kind of that relationship between equity and rate vol? Because personally, I think that you should either be buying equity vol or selling rate vol, or maybe doing both. But I'd be curious about your take.
Sure. So I think, okay, you need to look at the properties of each market first, right?
Okay.
Equity vol is, like the skew on equity vol is perpetually, skewed to puts, right?
Right.
And, for reasons that everyone is well aware of, right? But when it comes to rate volatility, right, the skew will very happily move between positive and negative, right? Between, calls and puts.
Meaning that at times people will pay more in implied vol terms for out of the money calls than they do for out of the money puts, and vice versa.
And vice versa, right? So when you look at, the skew, you will see it over, decades. You can see it shift, right? Up and down, right? As to, according to, how bonds have been moving, right? So
is it according to how bonds are moving, or how people are scared about what the next move will be, or is that one and the same?
It's kind of one and the same. Sometimes you can kind of fit it to, yield curves as well.
Okay.
Right. But, like the most recent example is if you just look at the 25 delta skew, right?
Yeah.
For like 1 month out on the 10-year note, right? TY.
Right.
For CME tickers, ZN, right?
Yeah.
If you look at that, for the majority of 2023, people were paying up for puts more than they were for calls, right? But after that QRA once that QRA, I guess, ignited that rally because sentiment was so poor, right? And then we had that huge kind of November, December rally.
Yep.
That eased financial conditions. You saw that skew flip in favor of calls.
Okay.
Okay. So
I'm with you.
so if I like to try and reduce everything down to a basic level, right? Because I'm a dumb person, so I need things basic. And that's why the book that I wrote was also, bonds
Yeah, we
basics.
have to talk about
right?
that. We're going to talk about that
But
as well. Don't you worry.
Sure. But the point of all this is just that what I was saying in that tweet is, people were paying up for calls on bonds, right? More than they were on puts. So they were more worried about upside than they were downside. Okay.
Okay.
But that has been coming down, which means that, that bullishness for bonds has been receding. At the same time, right, I was noticing that like things like VIX or equity vol, right, was starting to get bid and moving higher, right? Because it was like
Right.
12, I think, right? Then it was shifting up to, kind of 13, 13 half,
Yep.
around those levels. So when I kind of take those two and, just kind of stick them onto what you're seeing in terms of the market, right? You had gotten to a stage where the market was pricing in a lot of cuts, right? Just before that, right? Before that tweet, you even had March odds being priced at 100% at one point, right? For the Fed to cut.
And
right?
there's 7 priced in for the end of the year. Like it was
Yeah.
crazy. Yeah, it was
Right, and
lots of cuts. Yeah.
I think that was after the PPI number, I think.
Yeah.
Right. So, when you see that level of bullishness start to recede, you can kind of think to yourself, okay, people are kind of sobering up a little bit, and they'll push yields a little bit higher, right? So a lot of these buyers are kind of stepping back now.
Right. Okay.
Right. Then at the same time, you look at equity vol, it's like, okay, equity vol is going up because, the correlation between equities and bonds have been very strongly positive, right? And they've continued to move together. But right now, that's why I had like another comment that, equities don't realize bonds have already gotten off the bus.
I know. I actually quoted that one. That was I was going to do it. You said, "Love it. Equities trying to ignore that bonds have already gotten off the bus," which is a great line. What do you mean by that? Why don't you explain to people like when you say that the bonds have gotten off the bus and equities haven't realized it yet? What is the implication there?
I mean, the very general kind of implication is that if the market, moves from 7 down to 5 cuts, and then from 5 maybe down to say 4 or 3,
yeah,
right? This tailwind that allowed equities to kind of have a free and clear runway to move higher is getting blocked, and equities might actually have to take a step back.
Yeah.
Right.
I completely agree. I pulled up a chart the other day of the NASDAQ versus the long bond future. And I just did like the kind of the 30-minute one, and I just pulled it up since, I don't know, probably October. And it's like, I laughed and I said, everyone thinks that they're trading NASDAQ. They're really just trading long bonds.
Well, yeah, right. I mean, the other thing, like some people will say, is that during inflationary regimes, right, equities and bonds tend to have a positive correlation, right?
Yep.
But you're getting to a stage now where everyone is saying that inflation is moderating, right? We're no longer in a very rapid inflation kind of regime, right? So, how much more do you have to kind of bank on this positive relationship between equities and bonds, right? So
do you think that relationship's breaking? Like the positive correlation between bonds and equity, or bonds and equity? Do you think we're going to return to a more normal negative correlation?
Well, I wouldn't call it normal, right?
Okay,
but
disinflationary period of it, like
there is a chance. So we got to understand that nothing's set in stone, right?
Yeah.
And the nature of markets is that they are about cycles, right? And cycles are never static, right? They move around, right? And things change. So, I think there is a chance, right, that you get into a bit more of a negative relationship between the two. But I think for you to see that, right, is predicated on this idea that you have an economic slowdown.
Oh, I get it. Okay.
Yeah. If everything stays, hunky dory and things don't slow down, then it's not necessary that bonds have to trade inverse to equities, right? In that case, if you have a very steady state of growth, right, inflation is managed to be tamed, right, and kind of near the target, then lower rates is lower financial conditions, right? And that's generally positive, right? It's equity positive, it's probably credit positive as well.
Speaking of credit, I see that you had you answered a question by Macro Curd. Curd, is that how I say? Yeah, Macro Curd.
Mm-hmm.
He says, "Here you go. You can put on one position. You can't touch it till December 1st, 2024. What is it?" And you said long CDX HY. Now, that is the credit default swap. And when you're going to have to excuse me because I've never traded one of these in my life. When you say long, does that imply you're betting on credit blowing out or staying tight?
Well, that's a good point. Because I wasn't clear in macro Keto, so I had to ask, right? So
I didn't realize that. I didn't notice that.
It's one of those things with bonds as well. When you say bonds rally, I think a swaps person, when they hear that, they think that yields are going up.
Oh, yeah, okay.
Right. The
yeah.
The Govy guy will think that price is going up. So what I'm saying is that I want to be short the risk. I don't want
right. So you think that spreads are going to blow out?
Yeah. Well, it's it's a free bet, right? It's a free bet. So
now, why don't you explain to people why it's a free bet? What is that bet? What does it mean, and why you feel that way?
Okay, in general, right? When you look at risk, whether it's assets or credit, you're very much priced to perfection right now. Okay. Because the general narrative in the economy is, soft landing, right? For some reason, a soft landing means the Fed's going to cut, 5 to 6 times, possibly 7. But then, credit spreads are, massively tight, right? High yield in the US, their spreads over investment grade spreads, that right now, is like incredibly tight. I think like investment grade spreads are like less than 100 basis points, over.
Meaning that you're not getting paid very much to take that risk. So your argument is that if worse comes to worse, it's going to trade like the absolute most you can lose is that 100 basis points. It could go to 0, which it never will, but let's just imagine it did. It could go to 0, and that's the most you could lose. Meanwhile, if something were to go wrong in the economy, then those things could blow out to 500, 600, which would be what you'd expect in a negative environment, negative risk environment.
Yeah, exactly.
So you're not actually bearish on the economy per se. You just think the pricing of this is such that it's so tight that it's almost like a can't win on being long it.
Yeah, pretty much. I mean, there's a number of other factors when you look at it. Like this year, you start to get into the refinancing window. I think for investment grade in particular, it starts this year. High yield, they probably will start maybe next year, if not 2026. That kind of wall of maturities, right? That comes in.
And the market will widen ahead of that. I'm assuming is what you're betting. Well,
look, if you're refinancing now, right? Yeah. Say you're refinancing on a 10-year, you're doing it, with the benchmark at 4.13, 4.14%, right? If you're a high yield guy, you're probably going to issue a little bit shorter, right? So, the 2 to 5 year, let's say 5, maybe around 4% because the curve's so inverted, right?
Yeah.
And the spreads are tight, so that's good for you, right? You don't have to pay up too much. But like, let's say the market by December is in a recession, right? The economy is in a recession, right?
Okay.
Sure. Those yields can come down. Maybe the Fed will have cut 7 times, right? 125 basis points, 150, something like that, right? Maybe 175. That's quite a lot. But your 10-year, right, has come down to 325. Okay, so your benchmark is down there. But in a recession, do you expect, high yield spreads, which are now 320 over over sovereigns to only just move 125 basis points.
No, they're going to move 400 or 500, right?
Yeah, they're going to move a
Right.
lot more, right? So, that aspect of the credit spread, right?
Yeah. No, I
provides
completely
you
get
some
it.
upside. Now, I'll pitch you the other side, all right, Kevin?
Okay.
Let's say you get to the end of the year, there's no recession. The economy's still strong, right? Do you think it's rational at that level, right, that the curve is still, inverted by, 30, 40 basis points?
But isn't the curve a different bet than credit? And can't you separate the curve bet?
You can separate the curve bet. But my point is, right, okay, that, like, okay, 2 years right now are at 4.3, right?
Yeah.
The 5-year is at 4%, right? Let's just call it 4, right? Now, if you don't have a recession and growth has held up, right? Like, how much do you think the Fed would have cut by the end of December? Maybe 3?
Yeah,
3
okay.
times to normalize that.
Let's just
right?
say they do what they said they were going to do. 3.
Sure.
Yeah.
So your front end has come down, right?
To 3.
Now
yeah.
Right. Now, as you go out the curve, right, does that necessarily have to come down? Because right now, right, this is getting into your point of forwards versus spot curves, right? Your curve is already priced in for these cuts, right? And it's already priced in for 5.
Right.
Right? So if you don't actually materialize out to 5, you maybe get 3, right? Then the data has held up, right? What does that say about 2025 and 26? What does that actually mean for how many cuts are already priced into the curve? If they get priced out, right, you do have a chance where the Fed has normalized the front end and your longer end has to normalize higher.
Okay. So actually, you've talked a couple of times about this, the forward yield curve, and why don't we just take a moment to explain that, because I think that a lot of people don't really appreciate that. They'll say, "Oh, I'm long the steepener," and they'll say, "I go and I put it on today. It's trading at, let's just say, I don't know which one we'll pick, but let's just pick one here. Let's do it together here with the Bloomberg." So we'll just do two. Which one's nice and steep? 230s, right? Like, so we'll do 230s.
Sure.
And we'll go and we'll say, okay, the 230 right now is trading at 0, basically. Okay, it's 1.5 basis points. Now, the trouble is that if you sit there and let's just say a year from now, it's at 25 basis points, you might think, oh, I've made 25 basis points. But the reality is that the forward curve is trading probably 40 or 50 basis points. And I don't think enough people that are not bond folks understand that it's not a question of the absolute change, but you actually need to beat the forward change, what's already priced in. So maybe you could explain that a little bit and how that works and give a little more insight into it.
Okay, so, like, first of all, the forward curve is not a predictor of the future, right? So forwards and the future, not a future, the future. Forwards and the future are different things, right? A forward is the break even, right, for what you have today. Okay, so just looking at one bond, right? Let's say the 2-year, right?
Okay.
You can invest in a 2-year right now, right? And then in 2 years' time, right, you can roll it again and invest for another 2 years, right? So over those 2 years, right, you'll be compounding your investment, right? I can give you another option, right? Right now, you can just invest for 4 years, okay?
Okay.
Right? So if you invest for 2 years, I will pay you an interest rate right now for the first 2 years of, say, 4%, right? If you invest for 4 years, I will give you 4.5%, all right? Now, every year you earn 4.5%. Now, the thing is that you don't know whether it's the right bet to buy the 2-year right now and then in 2 years' time roll it, right? Because I don't know what interest rates will be like in 2 years. So the
Okay.
alternative is that I can just lock in the 4-year, right?
Right.
And then do that. Now, if I were to come to you and say, all right, fine, right? You're not so sure about the 2-year at 4%, right? So what I'll do is I will also, right, guarantee you that in 2 years' time, I'll give you that investment at 4% again, right?
Right.
Now, if you did the math on that, you would realize that to do 2 and then another 2 at 4% each time won't give you the same amount of interest as if you just did 4 years at 4.5%,
Right. Okay.
right? So immediately you'll say, no, that deal that you gave me on that 2-year investment, 2 years forward, is not a good deal. It needs to be higher, right?
Right.
So that's what forwards are. Forwards are just the mathematical break even, so that if I do multiple investments, right, up to a certain length, it's the same, right?
Right.
It's the same economic payout as if I just did it in one shot, right, from the start. Okay, so that's what forwards are, right? They're just the break even. Okay,
Right. Okay.
that term break even is important for what you were just saying about the yield curve, right? It's all priced in right now, right? So in a year from now, whatever is, kind of priced as a 3-year, right? In a year from now, it will be a 2-year.
Right.
Okay. Now, the thing with investing in bonds, right, is you mentioned it at the start of this interview, is like riding the curve, right? Now, when you invest in bonds, what you really like is a normal curve, which is sloped upwards from left to right, right? The higher you go, or the longer you go in tenor, the higher you go in yield, right? Because what happens is you can roll down that curve, right? So your 3-year becomes a 2-year. The yield, right, has come down, right, to where the 2-year is. But you have a bond that you bought that was a 3-year. So its coupon is naturally higher, right?
Right.
So you benefit from that rolling down, right?
Yep.
And you benefit from that carry, okay? But the problem right now with curves, right, is they are inverted, right? So what happens is that instead of rolling down a curve, right now you're rolling up a curve, right? So you're actually ending up losing money, okay? And the problem with that is it makes it very expensive to hold these trades, right? So if you're, for an easy way to think about something like carry is, if you bought a 2-year bond right now, you'd be earning, right, a yield of 4.3%, right? But if you
Right.
financed it through the repo market, you'll be paying, say, 5.3%.
Right. So it's negative
Okay.
carry.
So that is already a negative carry, right? For me to finance this position for 1 year, I'm going to earn 4.3%, but I'm going to have to pay out 5.3%. I'm losing 1%, right?
Right.
That alone is very tough, right? Now, like I said, the point of of forwards, right, is there's a natural break even, right? If nothing changed in the curve, right, whatever is, say, 1 year forward, right, or like 1 year longer, right, in a year's time will be, the curve that I hold today, right? So a 230 is at 1.79, right? In a year's time, right, the 31-year will be a 30-year, 3-year will be a 2-year, right?
Right.
And that's what that forward curve is, right? It's already priced in the market because those levels are determined by where the market is, how that curve is shaped, right? And that's why in a year's time, right, the only thing that I will basically have earned, right, is the carry and the roll, right, to bring me over to that 1 year forward curve. So an analogy that you can kind of use, right, and this is applicable to a lot of things, is like, oh, you like this, you're Canadian, all right?
Yeah.
Right?
Okay.
Yeah.
I hope it's not a beaver joke.
No. No, you got to get Jimmy on for that. Like that Wayne Gretzky quote, right?
Oh, skating to where the puck is. Yeah.
Right. Skate to where it will be, right?
Yeah.
That's not entirely accurate, all right? This is where, like, I upset you, all right? But that's not entirely accurate, all right?
Okay.
Skating to where the puck will be is the forward curve. that path is the forward curve. Everyone that is looking, that's in that rink, can see that's where the puck is going, right?
Okay.
If nothing touched it, the puck would just keep going along that path and, end at wherever it's going to, stop, right?
Yeah.
Might be the goal, might be the wall, whatever, right?
Yeah.
The job for us as traders or investors is to observe the game and see what is going to intercept that puck, right? What is going to push that puck to the left, to the right, to stop it, to flip it the other way around, right? To divert it, right? That is the process of being a trader and investor. So when you trade curves, right, your break even is that forward curve. You're not trading that. What you are trying to do, right, is take a view on something changing, right? Because right now, if you went into a steepener because you think the Fed is going to cut, you're not going into it because you think the Fed is going to cut. You're going into it because you think the Fed is going to cut more.
That is great. I don't know if it's the fact that I am Canadian, but I love that analogy. Listen, EMH, I could go on forever talking to you about bonds because this is so fascinating, but we have to actually kind of wrap her up soon. Before
Sure.
we do, let's talk about your book briefly.
Mhm.
It is completely free, right? Like this is just something you did. You decided I'm going to write a book, and you wrote like one of the greatest books for kind of newbie bond traders and also experienced bond traders out there. Why don't you tell us why you did it, how you can find it, what's it called, the whole 9 yards?
Sure. I got bored one day on Twitter, and I think educating people, if I can, is a good thing. I think that's important to be able to share what you know, as long as you're doing it responsibly.
Yep.
And the other part is also, it's like I said, right? The trading in bonds or like macro or whatever, it's a process of like discovering how much you don't know, right? And knowing that you know less and less, right?
Right.
But I do like to try and refresh myself because I think if you can have a good grasp of the concepts, right, that allows you to apply it to any scenario, right, and to understand how how the market might move on an intuitive level, right?
Yeah.
So that's kind of what I was doing for myself at the time. I was going through all of my notes, all of the stuff that I kept from like my training, things I've observed in the market, research that I've done into how certain things work. And as I was compiling it for myself to refresh, I thought actually this might end up being a good resource to share. So that's what I did. It started out as a thread, like multiple threads. That at the time was called, I think, Bond Basics with Bloomberg, I think.
Right.
BBB. Yeah.
Yeah.
Then, I thought the format to digest all of it on Twitter is not necessarily the easiest, right? So if I can compile it into a book, I can keep it for myself to reference, which is great. And I can, do that for everyone else. So the current version, of the latest one, is called the Ultimate Tourist Guide to Bondistan.
Yeah.
I think the cover that's available now is the Safe for Work version.
I know. I was actually going to ask you to change it, but you changed it without me, so it's good.
Yeah,
Yes,
a few people said they had trouble like leaving it on their desk at work.
Yeah, I was like, that's not. What do you like? You're being a little too musky with that cover. So for those who want to go find it, it is absolutely free. You just go to Twitter. By the way, you got to follow EMH on Twitter. Even if you're not a bond you're not interested in bonds, he talks about a million different other things, and just stay for the jokes. So it's EFFMKTHYPE. And if you go to his webpage on Twitter, you'll actually find the link on his kind of profile for the book. And I highly recommend everyone go get it. Even if you are like, know all these things and you just want to give it to, some of your staff or a young, a teenager that's interested in bonds, it's one of the best well-written books about how you price these things, how they work. It starts with the most basic kind of present value money, and it goes all the way to swaps and a million other things. It's absolutely fantastic. And I guess especially for those who want to do it on a Bloomberg, because there's lots of helpful tips there. Okay, let's finish off with my 3 questions. Okay.
Okay.
Let's start with what do you think is the hardest thing to do in trading and investing?
This is a little bit of a softer answer. I would say like championing and emulating other people's success. I think like a lot of people would say one of the hardest things to do is to recognize when you're wrong, right?
Right. Okay.
And that's got to do with, not just your process, but, stops when you're trading, right? To stop yourself out. I think the other part of that is, like I said, championing and emulating other success. The nature of our industry is that it's very competitive, right? Especially in derivatives, it's a zero-sum game. I win means you lose, right?
Okay.
And I think that tends to breed a little bit of sometimes elitist mentalities, but it's more like tall poppy syndrome. There is a tendency to try and discount others, right? Your process is not as good as mine. I think what's more important is to look at people and say, what you're doing is good. I admire that. I think it's very great, and I want to learn from you.
That's
right?
a great answer. It's actually it's just what I expect from you, UMH. Okay. Don Cox used to say that you shouldn't invest on what is on page 1 today, but what is on page 16 on its way to page 1 tomorrow. Do you have any trades or kind of strategies that you feel would get the Don Cox seal of approval?
I think that, this is a little bit of kind of like, macro codes question, in that page 16 kind of thing is, I was thinking about this, and I don't know if it's page 16, but when you look at the current kind of dynamics in terms of demographics and geopolitical factors going on in the world right now, one thing is, I think people on a previous guest have talked about climate change, right?
Okay.
And the impacts on migration, right? I think that that is one part of it. I think that the migration issues you are seeing throughout Europe, and to an extent the south of the U.S. with the borders there, right? That amount of migration that's coming in is going to put a larger emphasis on things like food security.
Oh, okay.
All right. So it's a question now of resources and whether, if you do continue to have, a very significant influx of migration, right, into various societies that not necessarily are producers, right, of, the required basics, right, then, you might have an issue that's driven from that in terms of food inflation.
Which we haven't seen in forever.
All right.
Yeah.
You've seen elements of that, like wheat, when the Ukraine war, flared up.
It was so minor, so fleeting.
But it was very minor, right?
Yeah.
If you look at the aggregate kind of agriculture indices on Bloomberg, they look like there's certainly room for some upside there, right? So in 12 months' time, are you going to see a case where you have potentially, I don't want to get political, but potentially, some conservative, movements sweep through different countries? You get a little bit more of a protectionist stance, especially as you see the result of, some scarcity and food security become an issue, right?
Got it.
Potentially that can weaponize. How you want to express that as a trade, one is directly through agriculture itself, right? The other is you can look at it in terms of, producers of equipment for farming, if you take a bit more of a positive spin on that.
Right.
Right. Or you can just purely look at things in terms of inflation, right? So, I think Europe is probably a little bit more at risk of this than, say, the US. this risk. So European inflation, if you want to do that, through break-evens or inflation swaps, that's one area you can look at. Just for whether or not this comes through. The other one is we talked a little bit about credit spreads earlier. I think that's probably one area. European credit spreads might be a little bit more exposed to an inflation shock at the second half of the year.
All right. Okay, now we're going to go to the question that Mandy left you. So I'm going to play it, and here we go.
So I personally love to travel. And so I would love to know from our next guest, what's the best place that you've been to, or what's kind of on your bucket list of places to go?
All right. What's the best place or on your bucket list of places you want to go?
Best place. I mean, I like traveling a lot, so it's tough to pick. I think one that comes to mind is this place called Lake Toba, Toba.
Where's that?
Indonesia. It's in Indonesia.
Lake Toba.
Lake Toba is it's a caldera. It's a volcanic lake, right? So it's a lake that was created from a volcanic eruption, however many millennia ago. It's the largest one in the world. The island in the middle of that lake is the size of Singapore, where I live.
Wow.
So it's a very fascinating place. There's a lot of ethnic tribes or ethnic minorities that live, around that volcanic lake. And it's got, it's quite an experience when you're taking a ferry across this lake over to this massive island.
So this is a freshwater lake. Like this is fresh water, but there's a volcano in a freshwater lake.
Yeah.
Well, that's wild. I'm looking at pictures. This is really cool.
Yeah, it's a very, very fascinating place. I really enjoyed it. It's nice for you to kind of disconnect, and just enjoy the nature. You can go up to the mountains. Yeah,
it's definitely a lot better than San Diego or like Hawaii. Okay, where is on your bucket list? Where do you want to go?
I'm greedy. I mean, I would say off the bat, I want to do the Himalayas.
Okay.
I want to check out, Nepal, Bhutan, Tibet. But I would also like to see, the Northern Lights.
Oh,
Iceland. I think that would be.
So I have done that. I have seen them growing up at my cottage because I'm Canadian, and so every now and then they came up and I would see them, but I didn't see them nearly as well as when I went to Iceland, and it is definitely an experience. So I would. Yeah,
I'm just going to go to your cottage then. We can
no,
open a beer.
No. That was when I was growing up, and I used to live farther north. I used to live in Winnipeg, and it's farther. Anyways, but the reality is, and it wasn't very regular. It was just kind of occasionally. But the Iceland, you got to go there. It's wild, and you could eat a puffin while you're there.
Okay. If you don't want me over, you can just say so, Kevin. Fine.
EMH, you're always welcome. You know that. Okay. What is your question you're leaving for the next guest?
All right. Wow. Let's go with geography. If you had to move, right? If you got kids, you're married, whatever, right? Or you're single, right? But if you had to move and live in another country for the next 10 years, where would you move to and why?
That's wild. That's a tough question. We'll see what people will be like. They'll be like the Canadians will move to the U.S., the U.S. will move to Canada. It'll be really boring.
Well, I think it's a great question. It's got a little bit of social, it's got a little bit of economic stuff wrapped into it when you think about it.
Yeah, no, I completely agree. Okay, so listen, we'll finish off with our last question, and I recently found out that I've been saying it wrong. I thought this Ted Seides, one of our listeners told me it is actually Patrick O'Shaughnessy from Invest Like the Best, I believe. He used to say, what is the kindest thing someone has ever done for you along the way with your career? I love this question so much. I'm going to ask you to share your kindest moment that someone's helped you along with your career.
I would say when I got grounded trading, I got tapped on the shoulder.
You got tapped on the shoulder. Okay.
Yeah. No, I mean, that was important, but they didn't fire me. I was like knee deep in a trade that I put on. It was winning, and I was trying to ride that comet.
Yeah.
And I was like sizing up, and then I got into that whole trap of you start to plateau and then you're getting your sizing wrong. Your conviction is there, but the market's not quite making sense because you're now at the extremes. And I was getting chopped up and my sizing was way off, and I was costing the fund, much more than I should have.
All right.
And the senior trader, he just like pulled up next to me and just said, "Take your hands off the keyboard. You're done."
Right.
And it was a very sobering experience for me, because it was at that point where I couldn't, like admit that I was wrong or that I was out of the trade, right? I had the right idea. I had called the trade right, but I was at the point now where I was just screwing it up.
Right. You weren't thinking
right?
straight anymore. You weren't thinking
No.
straight. Yeah.
Right. And so, your risk management goes out the window. So I had pushed it to the limit and, I got stopped. Right. And it wasn't like a huge kind of deal in terms of like shouting at me. They just said, just step back, relax a little bit and like just don't do anything, And for me, like it was very humbling. It was a little bit embarrassing, which is good, And then they just said, just worry about execution for now. You don't need to trade and, try and generate stuff, but tell me what happened. Explain it to me, what was going through your head. So it was a very kind of mature conversation. And I felt very appreciative that they gave me another chance,
Wow.
because in a lot of situations, you're out the door, So
EMH,
I think that was, the kindest
I'm
thing.
really impressed with that comment. It takes a lot of guts to come out here and say that. Like everyone always loves to talk about the winners and how great they are. And you came out here and you opened up. I think that there's a lot to be said for that. And I really appreciate that. I think it says that a lot about your character. I always joke and say that my tagline is all I bring to the party is 25 years of mistakes.
I love that line. It's on your profile. Great.
Because it's true. And listen, we all make mistakes, and I think that too often we don't talk about them. And I think it's great that you've chosen to talk about them, and I really am appreciative of that. And I'm also appreciative of your time. You got up on a Saturday morning to do this. You are just a real trooper for that. Why don't you tell people if they want to learn more about you? Is it Twitter? Is that where we're going to send them?
Yeah, send them to Twitter, go to my profile, read the book that's linked on my profile. If you want, you can always, slide into my DMs with the right opening. I might respond. We'll see.
All right. So once again, it's EFFMKTHYPE. EMH, thank you very much for your time. You're just an absolute blast. I look forward to having you on again.
It was a pleasure and an honor. Thank you.
Thanks. Take care. All right, Patrick, talking charts. Take those crayons out of your mouth and let's see what you got.
All right, Paul. First of all, let's just talk about the top three things we were watching for the last couple of weeks. We were watching those global PMIs, and the economy seems to be just plugging away. There's at least no cracks in the armor from them getting worse.
For sure. I don't think that we're getting the collapse like everyone thought that we were going to get, and bit by bit we're inching higher.
So number two, we were looking at the earnings season guidance. And while certainly there's been some misses and some of the guidance has been lower, but the big ones are coming up. I want to talk about that in a second. But number one was the global central banks. We had Bank of Japan, ECB, Bank of Canada. What did you take away?
Well, a lot of nothing, right? In terms of Japan, nothing happened. Bank of Canada, he still seems to be being hawkish. We had Lagarde today. She seemed to have tilted a little bit dovish, but it was just it's a big yawn, really.
Yeah. All right, so let's talk about the top three things to watch over the next 2 weeks. And number three, I put the jobs numbers, and I put it as number three. Usually I'd put it higher, but it's been pretty much in line month after month, and I don't see this being the month where it breaks. And so, it's worth watching because once we do have the uptick in jobs, that would be certainly something the market would react to. But I'm not weighing too much probability that this is the month it breaks.
I'm with you. What you got for number two?
The Mag 7 earnings. I think this is way more important. because what we're continue to see, and I won't talk about it when we get to the charts, is that the breadth is starting to turn, and these Mag 7s continue to be sort of the leadership that's driving this last impulse. And the earnings really have to keep that going. If the Mag 7 turn on their earnings, that might be enough to begin some sort of profit-taking cycle in the market. So I'm not sure if I have too strong of a conviction, but watching that in the upcoming week is, I think, incredibly important.
Well, yes, with the kind of weighting of those 7 stocks, although they really should be 6, right? With Tesla coming down. The weighting being such a large component of all the indexes, it's just going to drive the action. Like, we could have a situation where those 6 go one way and the rest of the market goes another, and the index goes nowhere.
Right. And so number one is the FOMC, of course. And obviously, the market even a month ago was pricing in a much stronger probability of a March cut. That's been, market's been walking back from that, and it's now less than a 50% probability. And I personally don't even think they'll move in March. But the question is, do you think Powell comes in here and just kind of tells everyone, just chill a little bit? We're going to eventually cut, but everyone's a little bit too eager. You think that the language will come across that way?
I don't know. What's the point of him taking it off the table? I don't think he should.
I don't know. Taking it off the table. I think what I'm just implying is that just taking it off that immediately, that the rate cuts are imminent. I mean, obviously, I don't think he should be taking his pivot off the table, but simply kind of pushing forward when the rate cut cycle actually begins. Pushing back anyway.
Yeah, I don't know. It's gonna be interesting to see, because there's no doubt if he wants to cut next meeting, he should really be setting it up for this meeting, right?
Yeah.
So it'll be interesting to see how much he guides the other way and says, no, you know what, the balance of kind of, we're watching, we're expecting to start, but there's no real guarantee we're going to start next month or next meeting. And in fact, if kind of things progress like they are, we're actually probably looking for the next meeting, not this one. It'll be really interesting, Patrick. There's no doubt that for the first time, this one isn't a kind of all baked in affair, and that there is going to be some nuance to what he says and how he handles it.
All right. Well, let's talk the markets. So now S&P 500 and the NASDAQ have broken those December highs and are working a brand new impulse higher. And so we're now in a situation where this is being led by fewer and fewer stocks. I have here the breadth of the market already well off of its high, using that number of stocks above their 50-day moving averages as a gauge. But when you start looking at areas like, for instance, the Russell has nowhere near approached its December high. You'll take a look at the equal weight index, and it still hasn't been able to beat the December high. You're continuing to see that really it's those Mag 7 stocks that have really made that punch, pushing the S&P 500 and the NASDAQ to those higher levels, stressing the importance of what's going to happen on their earnings. In order for this to keep going, do you think there's a chance that there's a sector rotation that begins that can keep this going? I just think that the Mag 7s are so big in the index that it'll be very hard for other indices without it being, other sectors, taking the reins without it being an incredibly wide breadth in the market.
Well, it's a tough question, right? Because right now we have the Mag 7. It's such a large component. And if we get a situation where it sells off, even if the other sectors get a bid, I suspect that we're going to still find the stock market lower. But in terms of whether we could see a rotation and get kind of a bid to the rest of the market, I'm not as kind of pessimistic about that idea as a lot of folks are. A lot of kind of the talk out there seems to be, well, this is the final stage of the rally where just the 5 big stocks rally and everything else is for sale. I still think that there's a chance that we could broaden out and we actually find some of the other stocks getting a bid, and all of a sudden, instead of talking Mag 7 all the time, we're talking energy or industrials or something else, a month's time.
Yeah, I definitely want to talk about these energy stocks in a second. By the way, we forgot to mention it here, but we're recording this part of the show actually a little bit early, so this is actually a Thursday close.
That's right.
So when we're talking about this, we still haven't seen, for instance, what the market reaction was to the core PCE index, even though probably is not going to be a market mover.
Great. Good job, Patrick.
Did I just go
when everyone's watching this and going, oh my God, Friday was the craziest day ever. And then if you want to know why, it was Patrick saying that.
I Gucci'd it. All right.
You Gucci'd it. Okay. What else you got?
No, but but it's just I want to just talk about, first of all, these Mag 7s, right? So on Tuesday, we have Google's earnings, and you can see like Google's just been ripping it on the upside, an advance of like $15 in just 2 weeks. And then Microsoft as well, which is also on Tuesday, continues to just plug away. That's followed up, obviously, Wednesday we have the FOMC, and then we have on Thursday Apple and Amazon. Now, Apple hasn't made higher highs yet. This has been the laggard in the group, even though it was an impressive rally off of its oversold state. But it's one of the few of these Mag 7s, including Tesla, that has not been able to beat that December high. But watching, Apple's been one of the ones that people have been skeptical about. I think this one is a little bit more important than the others. And then you have, of course, Amazon, which also continues to plug away on the upside. The only one that's really pushed forward is NVIDIA, which I think is deeper into February.
Right, it's Feb 21.
Yeah.
And that to me is the kind of the poster child of this rally.
Yeah.
Interestingly, Patrick, I noticed that it passed Amazon as the third biggest stock.
Wow.
Isn't that crazy? Like NVIDIA is worth more than Amazon.
Amazon is a retailer, though, but
I guess so. But it's just for the longest time, it was like Amazon was the big one, and NVIDIA is bigger than Google, and now I guess Google split, so you actually have to add the two up. But let me see if I add the two up, whether NVIDIA is now has a larger market cap. I'm showing NVIDIA as 3.69% of the S&P. And so Alphabet is 2.14 and the other one's 1.83. So so the old unsplit Google is still worth more than NVIDIA, but not by much.
Not by much.
It's just unbelievable. Mind blowing.
Yeah. And it's not like their earnings are catching up to this lofty valuation. So
that's not true, actually. The one thing about NVIDIA is that if you look at it, they actually have been earning just a shit ton, like to be technical, but
technically a shit ton,
right? But the real question is, can it continue? Like, how much is this just everyone rushing in to buy chips, and it just ends up being kind of a flash in the pan because everyone feels like they can't be left behind? And what's the demand for those chips going to be like in a year, 2 years time? The bulls will say, oh yeah, it's going to continue growing. My suspicion is that it ends up being much more kind of a situation where everyone felt like they had to go and buy it because they didn't want to miss it. It's just like, remember in COVID, when all of a sudden the kind of people realized that they were actually going to have a lot of demand for everything. So everyone ordered extra stuff. So you had buyers and like even just retailers. Yeah. Retailers were ordering tons of things because there was there was a limited supply of it. Just take like mountain bikes or bikes or something. There was a huge like demand for it. There was this huge surge in demand for mountain bikes, and then all of a sudden there weren't enough mountain bikes. So what happened was everyone doubled, tripled their orders because they all thought, okay, I got to add more and stuff because of this huge demand. And then eventually when it came, there wasn't enough, the supply finally came on and the demand wasn't as high as everyone expected kind of a year from then. And I suspect that's what's happening with the AI chips as well.
Well, I Anyway, I agree with you in principle on that. Just I think these earnings are just gonna be critical. It's just like when you saw what happened, like with 3M and others. When a company misses, they just nosedive, and this would be a huge blow to the market if a few of these Mag 7 stocks started to get hit badly on the downside.
But the other thing is, Patrick, in terms of earnings, the one thing I've noticed is, yes, if you miss, you get destroyed. But there's ones that literally are beating. They're opening up 5% and then finishing the day up 10 or 15%. And that seems to be something that's occurring over and over again, like American Airlines today. I think IBM did the same thing. If you have a look, let's just, in terms of it opened. Oh no, it sold off. It wasn't the perfect thing. But I've noticed this kind of pattern where you get it, where it opens up 5 and then goes up 10 by the end of the day.
Yeah, I mean, right now we're at the stage of the market where everyone is chasing momentum, and the things that are working, they're going to put more money to work in those things and avoid the things that are stuck in the mud, right?
It just feels like there's more volatility around the actual earnings than in the past. Maybe I'm wrong, and for those quants, will probably say, no, that's actually not correct. But it feels like the market is getting more right or being surprised by earnings more than in the past.
Yeah. What is
whether to the positive or to the negative?
I was reading Charlie McElligot's recent piece, and he was asking the question as to whether vol is priced right, considering how much headline news risk there is event risk there is going into next week. What's your take? Do you think that with vol being down at the lower end, that this is a cheap time to buy some gamma into so much event risk?
That trade's never going to work. And the reason it's not going to work is because I'm long tons of vol. So, yes, I do feel that. I felt for the past week that we actually have a situation where the stocks started rallying. And I thought to myself, this is feeling more and more like one of those environments when stocks can go up and vol can go up with it. Because as the stocks get more kind of just get me in, like kind of panicky feeling in terms of getting bought, that you get a situation where, what is that Bob Farrell rule that he says, markets don't correct by going sideways?
Yeah.
Like, so the faster, and you talk about this lots of times, Patrick, you talk about the speed of the rise kind of means that the correction is going to be all the more violent. So to me, I think we're getting
of it.
Right. I think so. We're getting to the situation where like NVIDIA gapping $20, $30, $40 a day, and it's such a big, important part of the index. It's feeling like we're going to get a moment when NVIDIA turns, and I don't know where it is, but I think it's going to give up half of its rise in a day or 2 days. And so when that happens, I think you're going to find that vol goes up. So yes, I do agree with Charlie, and I think that buying VIX, although it's a terrible trade and I hate myself, I feel dirty doing it.
Just go along a straddle in the markets. No,
yeah, but if you, it's almost the same trade if you do it properly, like with the things. I just like the VIX. I like doing the direct trade on that and not having to worry about hedging my delta and going through it and stuff. I'd rather just trade the VIX pure, and so I agree with Charlie.
All right. Well, one of the trades that I've been talking all week with my members at Big Picture is whether or not oil was going to have a breakout, and it just waited right until Friday for that. I think just keeping it simple with a 50-day moving average was the easiest way to just watch whether that turn was happening. Now, I've heard a number of analysts out there saying that oil should spend the year far more trade range bound and is very close to fair market value here. But I mean, that I think when you're taking such a high level view looking down on the market, that's a great call to make for a year. But I still think that there could be $10, $20 whips higher and lower in oil that average that price over the longer term. I think that this kind of a breakout could send us right back to those September highs, and we trade up to the 90 handle on the upside of oil. Be really interesting to see going into next week whether or not this breakout sticks.
Yeah, I wish you hadn't talked about it because I have a piece half written and I'm actually going to publish it tonight. and it was going long oil too. So now we're doomed because both of us like it and think it's going higher.
But it's just not loved though, right? Like,
it's hated. It is so hated, and like part of my piece goes through. If you go look at the asset managers, like their short position, it's roughly as high as it's ever been. It's
really
the pessimism. Yeah, the pessimism out there for not the net, the actual just amount of shorts. The pessimism out there about oil is huge. Then at the end of the day, Patrick, it was the perfect vehicle to express kind of worries about the recession and the global economy collapsing.
Yeah.
And so, anyways, I'm with you. I like it. And so we're obviously going to fall right back below that 50-day moving average because both of us like it.
The one to watch for the signal, in my opinion, is Chevron. Obviously, there was acquisitions and other things that drove this move, but it took a trip below $140 in the classic turtle head formation, just to gun those stop losses sitting right below it. And if this slingshots back towards its December highs, then that starts to look like a bottoming formation, and some of these major oil companies might actually be establishing a base here. It'll be really interesting to see whether that pattern continues there, but definitely these energy stocks are at an interesting pivot here. Sorry, do you have a comment?
No, go ahead.
Anyway, I just wanted to move on. The interesting thing is that there's a couple places like the refiners where there's a few of these stocks that didn't get the memo that oil is hated, like Phillips 66. The oil refiner has just been nonstop advancing. Every dip is being bought.
But that's a slightly different trade. That's the crack spread as opposed to oil
refiners. That's the
right.
Absolutely.
But what I'm saying is, you actually could have a situation where if oil is hated, these guys do great because if oil trades cheap versus
spread,
that's
and
an
all the
input
other
versus their
yeah. But you know what though? But look at a stock like Valero, which is just coming off of its lows, or PBF. And a number of these, they just Phillips 66 is kind of marching to the beat of its own drum. It's not the reflection of the entire space.
Okay.
Right. And so the other interesting thing is, these nat gas stocks. Now, nat gas has been a gut wrenching volatility. Like, I just actually can't believe what we witnessed on this whipsaw. Like, this is insane, where literally in 1 month, this thing goes up 50%.
Yeah.
And then wipes out the entire gain from top to bottom, a 30% wipeout in 10, 11 trading sessions. This is not even, it's like a 5-6 trading session.
Welcome to trading nat gas.
It's like, this is called margin call heaven. Like, unbelievable.
No, listen, it's the craziest of all commodities. It really is. It's got I should go look. It has to have the most actual vol. Like in terms of realized vol, doesn't it?
Well, I don't know what else could be this volatile. I mean, it's not lumber or anything. No, it's got to be this. I don't know. Like, I mean, there are other volatile commodities, but it can't be anything that moves like this. Anyway, but what I wanted to just touch on is the actual nat gas stocks, because they haven't been really doing anything out of the ordinary that isn't in line with a lot of the other energy plays, right? Like this is Ovintiv, just temporarily made a little bit of a lower low, but you can draw that nice thick crayon line of along all these highs, and you can see that there's a potential breakout happening in there. But you take like a Range Resources, which has been consolidating along there, a little bit more in the doghouse here. But point though is that it'll be interesting to see whether these nat gas stocks start to move again, and particularly even the liquid natural gas place like LNG, which really was making a 52-week high until it started this little 1 month correction. It'll be interesting to see whether the entire energy basket turns here, or whether it's just going to be focused on one particular segment.
Yep, we'll have to tune in to find out.
Yeah. Let's talk about copper. What an uptick on that.
Well, the world economy must be doing great. Something changed overnight, obviously.
Wasn't it the China headline?
I don't know. I'm just laughing because you know how much I love the metal with the PhD in economics.
I still subscribe to it. I'm the other side of you, and you can make fun of me every single show. I'm not going to change my tune. But the thing is that my view has always been that it's actually trade range bound sideways, not that it was going to be bearish. I just simply don't think it's the next bull market in copper starts just yet. I think we have to be on the other side of an expansion cycle. But anyway, that's a whole different story. Point is, this is a breakout candle, and what's interesting about this kind of a breakout is that it really does leave the window open for a trip back to $4 plus on the upside of copper. And if that happens, what's interesting is that when you look at these individual copper stocks like Freeport McMoran, they started to get these pops. Obviously, Freeport has a little bit of an earnings thing going on there, but you can take like a Southern Copper. Suddenly these copper plays are getting a little bit of love. It's far different than these iron ore plays and that have been hammered, but it looks like copper might have a little bit of a push here.
Okay. By the way, Patrick, you're a big option trader, and you're Canadian. Are you guys trading the first quantum?
No. Should I be? I should.
I don't know. For those who don't know, First Quantum has a mine, and I can't remember, it says somewhere in Central America that is in dispute, and they've had to close it down. And in the meantime, they've gone and we have a situation where the cash flows are looking a little more dicey, because now all of a sudden, without a mine operating, the debt that they have is a lot more onerous. And there's talk about Barrick coming and taking a run for them. It's pretty fun stuff, Patrick. Pull it up, FM on Canada. No, you got to do Canada.
Oh, there we go.
There you go.
Yeah, that's a good hammering.
So, Patrick, you got to go have a look at that, because if Barrick comes, the vol is actually good. Be quite cheap.
I haven't been following this story. But,
no, you got to go follow it, Patrick.
Yeah,
I think Barrick's going to come. I think they're going to make a run for it.
Well, there you go. All right, I'll put it on my radar.
Okay.
Big sell-off today in uranium. The U308 back to 101, but it's certainly coming off their highs. My first call here, it's a buy and dip. I'm buying the dip.
Like, what's the dip? Is that the dip?
That's the dip. I think
right. I like it. This is a call. I'm proud of you. This isn't like if it goes lower, whatever. This is, you're sitting there and you're like, this is time to buy it. Good for you.
You know what? No, because to me, we haven't seen a true bearish pivot, like topping formations, failed rallies. Often when things get into these bubble modes where they have this parabolic whip higher, you will often have, exactly like we talk about, the correction often is of equal magnitude to the rise. And so this type of a violent sell-off is sort of a reflection of just the 12% up week we had just last week.
And can I just interrupt here for one quick second? The other thing is, Patrick, this is actually, don't forget, it's a closed-end fund, and the underlying commodity has not corrected nearly as much. This is largely a function of the NAV, like the premium to NAV, going from 0 at the end of November to -10.
Yeah.
So that's like $3.50. It's trading, it should be like the spots on that's is $35.50.
There you go.
There you go.
And it's right now, because the U308 is at 101 right now, and it's only corrected off of like a 106 level, so it's like 5% off.
Really kind of. Oh, sorry. Go ahead.
No, it's just like 5% off of the high, but we're here a solid 10+% on the Sprott Physical. It's just by being a closed-end fund, it's going to have much more flows, retail flows that are trading around it, and therefore it's going to have more of these whips, right?
Yeah. The real question is, does it stop at 15 like in the past, where it usually bounced off of like when it went to a discount of 15%? Or does the fact that Sprott is kind of confirmed that they're not going to change the nature of it, and they'll never be, or at least they have no intention right now of kind of narrowing that gap through a mechanism of selling, you out in the marketplace and then buying back shares. And so the question is, does this go to like a GBTC premium discount of like 20, 30, 40%? I don't know.
I
doubt it now.
It's possible,
Yeah.
but I think that the rationale behind my view is that this is actually a bull market, and this is more importantly becoming almost like a bubble type price action. And when you have that kind of buying, you'd usually need something to burst the bubble to be on the other side. And I just don't think that the uranium has reached that bubble phase where we haven't seen crazy M&A. We haven't seen all the spec uranium mines come out. I still think there's more game to be played in this uranium bull market. At some point, it's going to get so frothy and so overextended that you have no choice but to get the hell out. But I think right now, the play is to continue betting that the prevailing trend will continue.
Okay. I hope you're right.
All right. So other than that, it'll be interesting to see whether or not bonds break further on the FOMC next week. I personally am of a different opinion than you on bonds. I actually think that the October low will hold for most of this 2024 year. The question for me,
yeah, but that's like, look how far away that is.
No, right. But I actually think that therefore this is going to be a buy on dip. So down here in this in the low 90s, I think it's an asymmetric accumulation point, betting for a return back to 100 plus on the upside, and so buying the dip here on this. I'm not like going full on bond bull where I think we're going to 120 to 140 on the TLT in a deflationary collapse, though it's not impossible. But we never want to rule it out, because then I'll have to take my Lacey Hunt poster off the wall. But I actually just think that there's a trade here.
Okay. Not impossible.
Not
Things
impossible.
can go to zero again.
Wow, it's not probable.
It's not impossible.
It's not impossible.
Yeah, 100%. You should. Good trader never says never.
So I wanted to just touch on quickly the Nikkei. What a run this has had. I think it still continues to be bullish. It's just holding up so much better. I think it continues to outperform against the other markets.
I'm with you. I love it. I've loved Japan for a long time.
The bigger question for me, are we going to see the emerging markets take a break? Because two of the hottest markets, and the charts look very similar, has been India, this is the Sensex, and Brazil. And both of them have had these amazing bull advances in November and December. And both of them have done one of these wedging consolidations back to their 50-day moving averages. And very similar to many charts, the first instinct is to buy the dip. And I certainly wouldn't rule it out. It is a primary bull market. The trends are very distinctly pronounced. And these types of pullbacks, this is now getting deep enough of a pullback where watching for buy on dips is tactical. And so I'm just asking that important question as to is this emerging market space going to get another punch higher, particularly in these kind of sectors that have done so well? And I know like you've loved Mexico, which had a pretty good recovery off of its October low, but the same kind of consolidation pattern. I think that almost all three of these emerging markets are either all going to work or none of them are going to work. I think actually it's going to be somewhat correlate as to whether money is going to flow in the space.
So I'll take the other side of that.
You think
I
which
think
one?
So Mexico and Brazil, I feel like they can go higher.
But you don't think India can?
No, I think India is getting a little bit tired, and as much as I love,
It's the same freaking chart, dude.
I know. It just feels to me like the valuation.
Oh my god! I wish.
Okay, but listen,
we can make a bet.
Well, yeah, we're not betting anymore. But remember when I told you? Remember I said you buy China, you sell India.
Yeah.
Remember we talked about that?
That was a horrible idea.
Well, could you pull up the chart? And in the meantime, I got something for you. Remember I called it the Maverick trade?
Gutsiest move I ever saw.
Can you? Is that it? Is that?
Well, this is the A50 on China. Is that the one you want to look at?
Okay, and I want it divided by India. Can you do that?
Yeah, absolutely. Once again.
That's the trade. That's the trade. You're gonna lose fingers, maybe even a hand, if this, or you're gonna be just an absolute star from this trade. Look, you made fun of me, and it's up.
No, the China market's been collapsing. What do you mean? You're saying
no. Like I told you 2 weeks ago, I said it's time, and you're like, no, it's too early. Look at that.
I'm disappointed.
Yeah, okay, whatever. It's a Maverick trade, man.
Honestly, I think everyone that's getting excited about China is risking being once again too early. It's not.
You know what? It's so hated. I
what do you mean? The amount
China?
of people that ask me whether they should be buying Alibaba, whether they should be buying this, the amount of people that
you obviously hang out with degenerates like nobody's business, because everyone I know wants to sell it. They're all like, "Oh no, this isn't going to stick. Oh no, blah 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 blah." They're all negative. Oh yeah,
because in my circle, everyone wants to buy this dip.
Yeah, you guys are degenerates.
I'm not interested though.
Well, anyways, I'm going to stick with my trade. China over India. It looks like so far I'm on side. So far I'm on side. You laughed at me. We'll see if you're laughing a month from now.
Let's watch this over the next month, because I want to see whether Maverick pulls his a rabbit out of his
goose
ass
or not.
Yeah.
All right. What else you got?
All right. No, that's good, man. That's
my turn.
Yeah, it's your turn. So, okay, hold on. We're going to just change the slide here. So we're getting to crayons with Kev, where Kevin pulls up a chart and sees whether or not his crayons are sharp.
Okay, so we're going to do the Swiss franc, Japanese yen cross rate. Can you do that for me?
Yeah. Let's just pull up the currencies here.
I'm going to admit that I'm like you here. Like you always tell me you're pure technical, and then you layer on all these fundamental views and try to come up with technical reasons to justify your fundamental views. So I'll be the first to say that me saying that you should sell this is definitely influenced by my fundamental views. But
okay, I'm listening.
Okay. So the move from April to October or September, nice, strong, steady uptrend, right? We roll over a little bit, then we have another move up, then we roll back down, and then we've had this move up. But this last move up, it almost feels like a extended prairie dog. We got above the new highs, and instead of it kind of taking off, it's gone sideways for a month. It feels tired to me, and it feels like the next kind of like just feels like it's rolling over, and it's just kind of the momentum of the rises is getting weaker and weaker, and that the next move is lower.
Okay, I'll agree that there's momentum loss. You can see that right there. When we put on any like MOM index or anything, you can definitely see that the momentum has shifted. By the way, just out of curiosity, how's the euro against the yen? Is it a similar chart? No, it didn't make a higher high the way.
No, it's different.
And so, are you taking the euro yen into consideration when making your call on the Swiss franc?
No, I'm just looking at one chart. I'm just trying to read the charts, man. You're making fun of me.
Well, listen, momentum loss is there. I personally like to know definitively that the trend has shifted before I push too heavily in. I mean, you could always dabble with a starting position here, but technically this is still a bull trend. All you're anchoring off of is a momentum loss, which isn't usually enough to already be short. But I mean, yeah, it's called gambling. You can give it a shot, buddy. you got no crayon support to your gamble here, bud.
Okay. All is well in the world with that analysis. All right.
Time for no stupid questions, and normally we invite Lena on, but Daniel, you're going to hold the fort for us here, bud.
It's okay, guys. Don't worry. I can do my best Smokey Lena impression.
That's right.
All right.
Our 3 female listeners are going to like it.
Okay, so first question. Hi, thank you for the show. It is said that in trading, round numbers are meaningful due to human biases. One could see in the DOM that liquidity of single stocks is usually highest at points like 0, 25, 100, 120, 5, etc. I'm wondering, is it the same with indexes like the S&P 500? If so, which instrument should be tracked, the ES Futures or SPX, since 4,800 in ES is about 4,766 in SPX, and it kind of messes with the rule. Cheers from Lithuania.
Do you want to take it, Patrick?
I mean, my observation there that it's more of a guideline than a rule. I mean, it's more, you're betting on like sentiment that, you know, in the broad amount of investors are looking for these round numbers and therefore target them naturally. And, you know, I think that I don't think I would even try to justify that you're tracking one over the other. I think the moment one of the two prints 5,000, the media is going to be all over it, irrespective of which of the two hits it first, right? Like, I think a headline porn is headline porn, and as soon as the S&Ps, one of them is printing 5,000, the media will be all over it.
I think that used to mean a lot more than it does. And I think it's a function of the nature of trading has changed. It's a lot more automated, a lot more kind of algos and things of that nature. I think that a lot of the modern day younger people don't care. Like they're just as likely to buy it at 10.01 or 10.06 as $10. I kind of question whether that round number phenomenon is still as prevalent as it used to be. And it definitely used to be. We used to sit around, you know, when Dow went through certain numbers or S&Ps went through certain numbers, there were a lot of people watching it and there were stops there. I'd love to see a study that says that still exists, because I'm going to take the other side and say it doesn't.
You definitely have the magnets of option strike prices that are sitting like you.
Well, that is true.
At the 5,000 mark, you're going to have like a monstrous amount of open interest that if it's short enough and the gamma is big enough that it's going to behave, let's say, as a call wall and stall it out up there, right?
Yeah.
And so I think the fact that there's and most people naturally pick the round number strikes when they're picking the S&P options.
Well, Patrick, I will give you that. I think that's a great observation. That the round numbers themselves in terms of trading don't mean as much as the round numbers mean when it comes to people choosing strikes on the things. I do it all the time. Like I'm looking for some out of the money calls and, you know, or puts on the S&P. And instead of buying the 4710s, I'll buy the 4700s just because it's round numbers.
Well, yeah, and you could 100% see the that just in the open interest. Like you map out the open interest, and you can see that where all the concentration is on the round numbers there, and so that definitely plays into it. All right, Danny, give us the next question.
Okay, second question. Hello all, love the show. Thanks for always putting out such great content. I was listening to Kevin's view on inflation, and he made the comment that it's a political choice and the genie is out of the bottle. I agree, it's a political choice, but please could you expand on A, in the instance the spending doesn't materialize, and I know the reasons it would, do you think the default is deflationary? B, bearing in mind the gilt crisis, do you think the US can get away with much more than other countries? I admit I'm asking at least in part because I have the same Lacey Hunt poster Patrick does. Also, You always make the comment at the end of the show to bring Lena in to save the show. I think that might be true after all, because the episode featuring Mandy Zoo without Lena was the most chaotic / hilarious one I've listened to, and I've not missed an episode for a couple years now. Protect her at all costs. Oh man, George, I hope I've done you proud.
I like this guy.
Okay, so this one's for me. Okay, so the first question is in the instance the spending doesn't materialize, do you think that a default is deflationary? So if the spending doesn't materialize and let's say, for example, the governments try to balance their budgets and they stop doing fiscal stimulus, then I think that everything that Patrick and Lacey Hunt and Rosenberg and all those folks argue will likely be correct. And the reality is that we have a lot of debt out there, and without that kind of fiscal side of it, then inevitably that debt kind of feeds in on itself and becomes deflationary and goes back, causes prices to fall. Now, the real question is, at what point, how much does our society have the ability to weather that deflationary crisis? Some people argued that in 2007 and 8 that we should have let everything collapse and then we would have gone and just reset. And there's no doubt, like I completely agree that if we had done that, we might have been, I don't know if better off, but it would have actually allowed the system to then reflate naturally as opposed to having the government do it. So it's kind of always weighing, when does that political choice kick back in? And I would argue that we've already seen in 2008 that we had no stomach for defaults. And in 2020, we had absolutely no stomach for defaults. If anything, we're getting less willing to take deflation and even quicker with the kind of remedies. And then the next question is, do I think the U.S. can get away with much more of this than other countries? So that's an argument that people make about the whole reserve currency status. I don't... If you go look at Japan does 250% of their debt to GDP outstanding as JGBs. So I'm not sure that that's actually the correct analysis. So no, I don't think that matters as much. And I think that it's a kind of a combination of different factors. One of them being how much the central bank was willing to actually stand in there and monetize it. And it's a complicated equation. And I don't think that the U.S. is particularly any worse than any other country at that.
Perfect. All right. Well, Kev, or actually Dan, where can people submit their questions?
Oh, shit, I forgot about this bit. Okay, so if you have any questions for Kevin or Patrick, please submit your questions to nostupidquestions@markethuddle.com. I'm the one that reads them anyway, so.
Oh my God, that was
well done,
awesome.
Daniel. Well done. Thanks for tuning into the Market Huddle. We appreciate you spending us some time with us. Please give us a follow on X at the Market Huddle. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. Kev, where can they follow your fantastic newsletter?
Oh, thank you, Patrick. At themacrotourist.com. And listen, we could never have too many friends. Bear market, bull market. We're just happy that you have spent some time with us. Now stick around for the quick after show. All right, Patrick, Time to rate your beer.
Well, you know what? I didn't know whether I was drinking beer or eating grandma's pumpkin pie. You know what? It actually, you know what? It had a lot of similar things to like a mulled wine, like cloves and cinnamon and kind of stuff like this inside there. Very earthy kind of taste. I think it's a fantastic seasonal beer. I mean, it's perfect for like a fall Thanksgiving thing. And more importantly, what an awesome name. The Theater of Madness.
Right.
Like
now, we got to ask Daniel, since he's going to be here for our after show, we got to ask him a couple questions. First of all, Daniel is English. He's not Scottish.
Can I rate it?
Oh, sorry.
I give it a number?
Forgot. Yeah, go ahead. Sorry. I interrupted, as usual.
I'm going to give it, I'm going to give it a very respectable 7.9. I don't want to go into the 8s, but it is actually above average, and I would definitely drink it again. Definitely try it next time they bring it back on the shelves. I know it's a Canadian beer, but those that can access it's a good one to try. All right, Now,
Daniel.
Kev.
Yes,
Daniel, you're British,
I am.
but and those heathens up above you in Scotland, they have a day today that they celebrate.
Yeah. Do you know
Robbie
what that is?
Burns.
Oh, you do?
Yeah.
Okay,
Actually, I don't know. I know what it is. I know who he was and stuff, but why today? And tell us about it. Does it just involve all the Scots drinking?
Well, I mean, we don't know the full story, of course, and I'm not going to recite the poem, but yeah, it's basically, you know, we eat some haggis, we drink some whiskey. That's all I know, you know. But he is essentially he was just a poet, you know.
It's such a great tradition. Why break it?
Exactly.
And do you do it in England as well? Like, do people? It's not just Scotland that they do it.
Well, if you have Scottish family, yeah, of course you're going to celebrate Burns Night. But you know, for us, it's the same thing as, you know, St. Patrick's Day. It's an excuse to get drunk, right? So.
Oh, okay. I get it.
Yeah.
Actually, the Rum Shack boys back in Toronto were all doing the Robbie Burns as well. So it's even made it to Canada. Any excuse to drink, men will do it.
Yeah.
So for those who don't know, Daniel sat there behind the scenes and kind of rated the beers that he's known behind, like afterwards. And he's much more of a beer snob than either Patrick or I. So what's your favorite beer?
Oh, no, come on. You can't put me on the spot like that. Do you know
Yeah,
what?
I
Actually,
can.
do you know what? I'm going to be a bit sacrilegious here to English people, but I love a Guinness. I just love a cold, frosty Guinness.
So do I.
It's beautiful. There's something just
What's it?
fabulous. Pork scratchings, pint of Guinness. You can't go wrong, you know?
There you go.
Yeah.
How about you, Patrick? What's yours?
You know what? Well, back in Toronto, I used to be unrefined and just do Moosehead.
Oh, that's a good beer. That's a good Nova Scotia beer.
Yeah, but
That's so Canadian, by the way.
Now,
Moosehead. It's like even the name just kind of reeks of Canada. Like even you tell someone Moosehead Breweries and they go, even if they never heard of it, they're like, that's Canadian.
Absolutely, it's. But I definitely have. You know, I now am mostly stuck on Portuguese wine, but you know what? Whenever I'm around, I definitely go to Guinness a lot, and I've Daniel's converted me.
Yeah, man. There's something great about it, you know.
Have you been, Daniel? Have you been to the Guinness factory or the Guinness whatever brewery?
You know what? I have.
It's a shock. I've been as well. It's actually, if anyone's there, they should go by and have a look at it. I'm going to talk a little bit more about Moosehead, though. I was just Googling it. It's actually Canada's oldest independent brewer. And, you know, we're usually kind of pathetic when it comes to oldest stuff. We're usually like, oh, since 1926. This is actually 1867, Patrick.
Wow.
And it's St. John, New Brunswick. Well, I thought it was Nova Scotia. It's New Brunswick. Fuck, I'm just insulting everybody today.
Did we invade you at that point? I don't even know.
Didn't invade. Actually, I was watching something the other day, and I realized that there was a point when we were worried about the American Revolution coming, and they were going to invade us. And Daniel, you guys put 5,000 soldiers on boats, and you sent them to Canada.
For the Guinness, for the Moosehead, right?
For the Moosehead.
Yeah.
But you did that to protect us, to make sure that we weren't invaded.
Yeah.
And you just, I don't think there was anything to do. So you just hung around and shot squirrels and did stuff like that. And but you did, and you never left.
No.
Yeah,
sorry.
Okay. Well, listen, I'll let you guys go because I know it's late there where you guys are in Portugal. You're going to go out and have some fun and enjoy yourselves. Thanks for everyone. See you next week.
Yeah. Thanks, everyone. Cheers.